Good morning, everybody. I'd like to first thank the Marketing Sciences for allowing us the opportunity to present, and thank all of you for attending. What we'd like to do today is really share a model, the BRAN EQT model, which has had a significant impact at Allstate in the way we look at many things from a marketing lens. Specifically, what we will cover today is really what was the marketing problem that Allstate set out to address, and I will take the lead on that front. Then we will start talking about how that management problem was translated into a marketing science problem, and that was a journey in and of itself because we have a number of different cultures at Allstate that have to be appeased as we go through this process. I'll spend a little time on that. Then we're going to lay out the model that was developed to address the questions that we had. Venki will cover that section and talk about some of the issues that we confronted in that process. Then we will turn into a discussion around what were the key findings, applications, and issues as we've been going forward, and Matt Fuller will address those issues. And finally, we will wrap up with a discussion of some of the organizational impact and actions that have taken and are being taken as we move forward as a result of the modeling work. Before I jump into the presentation, I'd like to give you a little background about Allstate, because I think it provides perspective on the nature of the problem that we were confronting. The simplest level of background is really, who is Allstate? Allstate is a very large property and casualty player, the #2 U.S. company in the category. We're approximately $29 billion on the top line, $150 billion assets under management, split across the home, auto, and life businesses. We have a market cap of approximately $37 billion. The three major categories that we are in play with is the auto, the home, and life products. There's approximately 17 million households that we serve. And the marketing budget is approximately $500 million, with roughly 280 or so million that are dedicated to advertising and promotional type activities. The other thing that I'd like to touch on briefly is some background on why I think Allstate is in an interesting position and why this was a very significant project. And is at the end of the day, insurance companies sell a promise to make a customer whole. We don't know when or how much it will cost to make this customer whole. And so when we look at it, it turns into a very large actuarial problem of trying to say, a given customer is going to cost us how much at any given time. And so we're not like IBM, who sells a PC and can basically figure out what their costs are on a particular day. We're not like General Motors, who puts together an Impala and has a sense of what that's going to cost. We don't know. And so when we look at something known as price, one of the 4 Ps, it looms very large, and there's a huge organization of basically populated by actuaries that build very sophisticated general linear models to understand what is the probability that someone's going to have an accident, and then what is the probability that the severity of that accident, how much we will have to pay out, will fall within a range. And so when we go through that, we quickly learn as an insurance company that price is king. Price is the #1 variable that we worry about, and everybody talks about it continuously. There's just one catch. Consumers don't really buy just on price. They say it's important, but there's another component that runs through the whole equation, and that's the relationship. If you look at Allstate, you look at State Farm, the 2 largest players in the category, and they're sold through agents. The majority of sales today are made through agents. So there's this great big relationship, soft and fuzzy piece that's sitting there. And within Allstate, we are confronted with this challenge. We have a group of people who are actuarially, mathematically very rigorous in defining price from an economic perspective, and then we have another group of salespeople who are very convinced and committed to the notion that it's about selling and building relationships. And really, when we get to the crux of why we brought in our new Chief Marketing Officer about 28 months ago, Joe Tripodi, it was with the challenge of how do we leverage the brand? How do we make it quantifiable, tangible, something real? In essence, how do we link the price P with the other components of the marketing mix in an integrated fashion? So we have both the soft and the hard integrated. And that's really what Joe's vision was all about and what he was setting out to do. And so I'll quickly go through these pages here, we look at when we started this, 3 separate marketing departments approximately 27 months ago. Marketing was advertising. And the goal was to really move away from that to marketing is the coordinator of the marketing mix. How do we integrate the marketing mix? How do you have 380 million prices and still have a means of communicating to consumers and coordinating it through the channel and designing products? The brand was really our tagline, "You're in good hands." How do we talk about brand equity, the real drivers of choice and how those choices impact value for shareholders? Advertising was viewed as an expense. When we were doing well, we spent more on advertising. When we weren't doing well, we turned it down. Advertising was really and is a profitable driver of growth. What is the ROI? And we've done a lot of work in these last 27 months to get at that. The next one was we were auto-centric. We make an awful lot of money on auto. We plan by auto, yet we have all these lines, and we really didn't know how the brand played into those lines, what was the role of the brand in choice. And so that was something that was pulled out. And the other one was there were no real standard marketing metrics. We had an ad tracker. Every time we would go up to the board, we would select and cherry pick from our tracker the best measures and show them. To a world where we moved to saying, no, there's actually a marketing mix, there's a funnel. We talk about how we manage awareness, consideration, choice, quotes, all the way down to sales rate. And we have specific targets that we're running to. And so as we were going through this journey, what Joe and the team recognized was the brand could serve as the way of integrating all of these questions together. And this helped us start to rethink how we wanted to frame the problem for ourselves and the organization. So as we set out to do this, we actually started talking with Venki and a number of vendors because we thought our problem was initially, let's just go get a great vendor and we will solve this problem very quickly. And we started running into some questions. It wasn't a simple mono-brand problem for us. We had, of course, the desire to value the brand, but we also wanted to understand each of the product categories because there were definite implications of whether we were talking about auto, life, or homeowners. Any of you who are familiar with what's happening in Florida will know that when there's a hurricane, everything changes. We take a huge beating. And so when we start talking about financial modeling, the financial modeling problem can't be done in a simple, straightforward manner. We really need to think through what's going to happen, what are above-the-line cash flow issues, what are below-the-line cash flow issues. And so those are things that we needed to incorporate in some of the methodologies that we looked at. If it was from Core Brand that did a very nice job on a number of dimensions, did not really allow us to see some of the below-line items that we needed to. I think some of the work recently been done by Y&R had similar issues that when we looked at, we loved the fact that they had an interesting financial valuation, but below-the-line analytics was not what we could really leverage, and there wasn't also the ability to say, how does this impact and differentiate my auto business, my home business, and my life business? And all of them have different risk profiles. So when we set it out, we said, here are the criteria. We need to be consumer-based. We need it to be actionable across the marketing mix for every product line. It wasn't enough to speak about the brand just for auto. We needed to understand what were the levers and what was driving choice and consideration for auto, home, and life. The next thing that we needed to have was a systematic linkage to the financials. The cash flows and how they operate is very distinct from the auto business to the homeowner's business where we have huge reserves, tens of billions of dollars of reserves sitting there, and it changes from state to state. And so we had to have a lot of intricacies being able to be accounted for by our financial actuarial teams. And then the life business, which represented a similar problem. The last one, it has to be tracker friendly. Nobody wanted a snapshot that we would walk away from. And so part of what we were looking at is how do we build a tracker and we can systematically measure the brand equity on an annual basis that will allow us to understand what are we doing and how do we start adjusting our communications, advertising, value proposition work in accordance. So those are some of the things that we set out to address and formulate around problem definition. What I'd like to do now is turn it over to Venki and have him walk through the model.
Thank you, Pablo. And for a marketing science problem, I want to walk you through the modeling approach. I want to talk about 4 basic elements of the brand equity model. The first element is the model of consumer choice. And here our approach is a choice model that was based on survey data collected from consumers in each category. And the basic purpose of this choice model was to understand what is the importance of brand relative to other attributes in consumers' choice of an Allstate or competitor brand. And in the second modeling element, we went to the financial valuation of from the importance of brand. And here we used the financial hard data that Allstate collected and the competitors had through various sources. So basically understanding what the net present value of the offerings that in the insurance industry is of the different products and competitors. And the idea is to calculate the equity of the brand combined with the offering value and the relative brand importance. And the third modeling element, we try to recover what are the elements of the brand that contribute or constitute the relative brand importance and the favorability of the brand. And so we use a regression model of brand favorability image, which again we collected from the consumers on the brand equity dimensions. These dimensions range anywhere from brand favorability, brand reputation, brand innovativeness, and we'll talk about that in the subsequent slides. And in the fourth aspect of brand equity, we took the brand equity measures and directly linked it to advertising, and separately we also linked brand equity to shareholder value. And this we accomplished through first computation of ad stock, which we will talk about later, and then correlating the brand equity measure with the net present value of normal returns computed through the Fama-French model and the buy and hold methods. Here's a quick overview of an overall model. The conceptual formulation of arriving at brand equity can be simply expressed in terms of 2 components, financial and consumer. Brand equity, we use the term to denote the net present value of incremental cash flows that's attributed to the brand name relative to an offering without the brand name. And this is consistent with all the literature definitions that we have looked at. And the first component is the offering value, the value of what Allstate or any other brand competitor might offer. And this is computed as the net present value of incremental cash flows associated with an offering. So this is broken down by category, by auto, by home, by life. And in the second component, based on consumer data, we compute the relative brand importance. And this is simply the proportion of contribution of the brand toward the offering choice after controlling for the contribution of the other elements, the marketing mix elements particularly. And the way we arrived at this framework is based on a careful study of past literature, which we did not have the time to go through here, but we looked at other literature which has looked at brand equity in terms of price premium, value premium, revenue premium. The advantage of this is that it captures the cash flow aspect as well as the consumer choice aspect that was very important to the company. What are some of the uniqueness of the model and the context? There are a few things that are important to keep in mind as we go and estimate brand equity in this context. One is, unlike packaged goods, consumers don't buy multiple units of insurance. So if you're an auto owner, you don't buy multiple insurance policies, you just buy one. And so when it comes to modeling the consumer choice, you don't have to wait for by units. The second important thing is purchase timing of these products are at fixed intervals. For example, auto policies are purchased every half a year, and home are typically every year. And also there is very much lower switching here compared to packaged goods because people tend to only renew them after when it comes to renew. And so the inertia inherently is high, so we need to capture that in the choice model. And the outside good choice is less relevant because most of the insurance is mandatory. Finally, most important element is that performance as when we compute the cash flows, it's very sensitive to catastrophes such as earthquakes, snowstorms, hurricanes, and so on. And these happen cyclically over multiple years. So we need to really keep that into account when computing the cash flows and projecting and forecasting the cash flows. So let me start with the first element of model, that is the computation of relative brand importance through choice model. Now, all of you may be familiar with the standard logit, but what we do over that is that we simply take the utility deterministic part and try to include the spillover effects of the brand, effective brand in one category than on the other. So for example, in the choice model for auto, we will have the effects of life and home brand on the choice of the auto brand. And we can show that the relative brand importance can be boiled down to this equation that you see as a function of brand and other attributes. And the other attributes are the ones primarily in the denominator. And the way we went about estimating that is through a number of models, primarily based on logit model. We estimated the mixed logit, heteroscedastic, extreme value, all of these by controlling for heterogeneity, IIA assumption, looking for face validity, looking for diagnostic information, and finally aggregated this across customers to get the relative brand importance. Now, let me talk about model element 2, where we looked at the offering value. This is the financial component of it. And here, from basic finance, we can show that the offering value is a function of the revenues and other terms such as EBITDA MR, which stands for earnings before interest, taxes, depreciation, amortization, and it's a ratio that we could get from the financial department of the company. And there are other terms such as inflation rate, weighted average cost of capital, marginal rate, that are a very important component of it. And the idea is that this is the net present value of an offering in each category when it is allowed to go in perpetuity. Now, from modeling element 1 and 2, we move to 3, where we talk about having computed the relative brand importance, having computed the offering value, we can compute the brand equity at any point in time. But what is important to the company is also understanding of what are the specific dimensions of brand that affect this brand equity. So we had collected a number of measures on different dimensions of brand perception based on past literature on brand equity. And some of these measures, some of these dimensions include, as I mentioned before, brand regard, brand reputation, brand innovativeness, and then basically ran some regressions to understand brand favorability on these dimensions to get a sense of what are the dimensions that are key. And what is the implication of doing this? For example, it helped Allstate know whether it was brand innovativeness that was driving the brand equity or whether it was some other dimension, and could compare with their competitors like Geico. For example, one of the things that came out, which I'll talk about a little bit in the findings, is that Geico was their brand equity is primarily driven by the innovativeness aspect. Then we'll talk about model element 4, where we, after having done the brand equity estimation, after having found out the influence of the dimension on brand equity, how do we now relate brand equity to advertising dollars? And how do we also relate this to shareholder value? So first, to understand the impact of advertising, we calculate the advertising stock, which is a fairly established method of computing the carryover effects of advertising through the COIC model. And the second equation that you see here is simply a regression of brand equity on the ad stock to find out if there's a significant relationship. And finally, brand equity being our proposed link between advertising and shareholder value, we try to find the correlation of brand equity that we estimated with the abnormal returns, the net present value, using the Fama, French, and buy and hold models. And this is the fourth step in the modeling element. And here are some key empirical findings that Allstate had. The first and foremost for the company is now get a handle, a tangible handle on what is the brand equity of the company. The numbers that I'm showing here are disguised to protect confidentiality, but they are kind of consistent, give you a picture of how it shapes up for the company. Most particularly, the breakout of the brand equity by auto, home, and life is very, very important to the company from a point of view of reallocation of advertising expenditures, which Matt will talk about. We found that 57% of the brand equity is derived from auto, whereas for the competitors, the market leader, State Farm, the same contribution is about 75%. And so it also gave an idea of how close is the company's market cap to the market leader's brand equity to the market leader's brand equity, and how can they close the gap, which is very important. So diving into some of the details, for example, one of the findings was relative brand importance were highest for life. The company didn't know that going before we started this project, and it was lowest for home. And some of the brand dimensions in which Allstate was strong or weaker relative to competitors also came out as a result of this exercise. We found a very strong relationship between brand equity and ad stock. In fact, it was a very stunningly high correlation, RR squared of 0.9. And we could compute the base brand equity, that being the equity of the brand when you stop advertising. And at higher levels, most importantly, when we explored the link between brand equity and shareholder value, what we found was the abnormal returns increased with ad stock or brand equity only at very high levels. So the implication is that Allstate needed to maintain a very high level of advertising and brand equity. And most importantly, the volatility of normal stock returns decreased with that, which is also a risk reduction mechanism. So the bottom line in terms of finding is that growing brand equity through advertising investments would be a very key way of improving shareholder value for Allstate. Based on these findings and the model, we built a simulator, which Pablo mentioned was for periodic monitoring of brand equity, which could break it out by the different categories, provide a diagnostic information, and will also give the ability to use managerial judgments or inputs to the managers to make decisions, such as advertising reallocation. And in the next few slides, Matt is going to take you through the impact and conclude the presentation. Over to you, Matt.
Thank you. As Venki said, what follows is a business impact, how this affected the decisions we made and the actions that we took. We observed impact along 4 dimensions: financial, strategic, methodological, cultural, and change management. Now, these dimensions manifested themselves across 4 areas of impact: category level brand equity measurement, long-term impact of advertising on the brand value, allocation of marketing costs, I'll talk a little bit about that, and then the advertising communications. In terms of category level brand equity, from a strategic perspective, this allowed us to provided us visibility of the brand equity contribution across our categories of auto, home, and life. It was a rigorous application of choice modeling, allowed us to bring in the consumer perspective, and also allowed us to look at the spillover effects of investments in one area spilling over into investments in another. In other words, our investments in auto having an effect on brand equity in the life business. And very importantly, from an accounting perspective, because this was accounting criteria compliant, it allowed us to sell this methodology very readily to our property and casualty insurance finance group, as well as the Allstate Financial, our life insurance and annuities finance group, which is very important. And also allowed us to take the brand, which traditionally had been a warm and fuzzy concept, and turn it into a marketing asset. From the perspective of the long-term brand value on ad impact, for many years, marketing at Allstate has been under pressure to demonstrate the contribution that it is making to the bottom line, to the business. 2 years ago, we started an effort to determine what the contribution of marketing investments were to the business and what the effectiveness was. This BRAN EQT project allowed us to extend that and look at the long-term effect of advertising as well, in addition to that short-term impact that we got from our ROI modeling. And that supported an increase of 85% in ad spending, which translated into a brand equity increase of 5% and a market capitalization increase of 11%. It allowed us to look at financial and consumer survey data together, and most importantly, from a long-term perspective, it provides a link between advertising investments and shareholder value. And from a cultural perspective, allowed us to communicate to the various elements within Allstate the contribution of the brand across those non-marketing functions. From a cost allocation perspective, this allowed us to realize about $10 million worth of savings. That spillover effect I mentioned a little bit earlier allowed us to see that investments in the financial areas of marketing were not necessarily paying off. They were getting sufficient spillover effect from the advertising in our auto and home areas, so we could take the money we were spending on the Allstate Financial marketing and reinvest it somewhere else. As I said earlier about the rigor, the financial rigor of this particular method allowed us to sell the allocation to our Allstate Financial group. Traditionally, our Allstate Financial area has gotten a brand tax or an allocation every year of the marketing expense. And organizationally, they've had some issues with seeing the effect or the actual contribution of that allocation to their business unit. This allowed us to show that, yes, the brand tax was fair, it was equitable, and in fact, it really supported an increase of that allocation. So the conversation quickly ended. So this allowed us to move from marketing as an expense to treating marketing as an investment from a long-term perspective, and allow greater management accountability. The project return on investment was huge, and this was calculated using from the dollars we spent in actually operationalizing the BRAN EQT model, and looking at the payoff from reinvesting the dollars that we were spending elsewhere into the home and auto categories, and seeing what the contribution was in those particular areas. This also reinforced some findings we were getting from other qualitative research, and actually put some figures to what the change in share of spending across the category in advertising, and relating that to an increase in brand awareness of about 18 points over a period of 2 years. The spillover of brand equity from auto to home and auto to life is great, so that allowed us to redesign communications to support that reallocation of the marketing dollars. And also, it also highlighted the impact of catastrophes on brand. Venky mentioned a little bit earlier that this particular category is highly sensitive to catastrophes, and we had to account for that within this model. Some practical hurdles. Financial measures for our competitors are not always transparent. We have a combination of mutuals as well as competitors who are embedded in other larger corporations. So we had to use multiple sources to get some of those measures. Forecasting cash flows is a function of catastrophes, so we had to do an upper and a lower bound on those cash flows. Ad stocks are not really transparent to a lot of people who are not in marketing, so we had to devise a method for explaining that. Plus, we had to set up a way of operationalizing this so that changes in personnel or changes in financial estimates could be handled pretty quickly. Plus, we had to partner with our finance department to look at the cash flows of other brands. So what did it do for us in terms of enabling changes to the culture, changes to the way people viewed marketing? Traditionally, marketing was unclear. The value of it was unclear across the business. Became apparent after the BRAN EQT model was operationalized that marketing is a high-value asset. Allstate's been in existence for 75 years. A lot of the employees at Allstate are very loyal to the brand, as they should be, but they're never able to translate that loyalty into an actual dollar figure, and this allowed us to do that. Advertising went from an expense to being an investment, and allowed us to move to a multi-category focus. It also helped us communicate more directly with our financial services unit. What we have from BRAN EQT is a robust, generalizable, and highly portable model that allows us to look at multi-category brand investment. It's a good blend of customer and financial measures, links shareholder value and advertising, and gives us reliable estimates of brand equity by the category. It also helped us justify the value of marketing within Allstate. Thank you very much.
Well, first of all, thank you very much for a very clear presentation. My first question will be pretty conceptual. Your approach is very much based on the value created by the brand to the customer. So it's very customer-based brand equity approach. And as you know, there are many different competing complementary frameworks of brand equity out there. What is your unique view of brand equity conceptually, customer-based brand equity?
Should I answer that first? Okay. Our view is exactly what you said, is a customer-oriented view, which is what is the net present value to the company of all the cash flows that are generated through the offerings that is attributable to the brand. And the way we looked at it conceptually was as if a customer would attribute that to the brand. I mean, because customers vote in terms of their feet and dollars, right? So we've heard that saying, and we looked at exactly how customers behaved in terms of their choices, looked at what the influences of other attributes are there, and then we just partialed out the effect of brand based on the consumer side of it. And then we married that with the cash flows that's generated and did that. Now, with your question regarding how does it compare with other approaches, I briefly mentioned in the presentation the other approaches range anywhere from price premiums to volume premiums to revenue premiums. And ours is taking some of those things, but at the end of the day, when we talked with the company, the finance people, the top management people only cared about the cash flows aspect. And to the extent that we could sell the idea that this much was really due to the brand and it came from the customer, and this turned out to be the most important framework that really became acceptable. So our work is related conceptually to the other work, but it's distinct because of the focus on the consumer side.
There's a lot of data that you've gathered and a lot of modelling that you've done, and at the bottom of this process, an internal rate of return of 2,500% is very impressive, and some fairly large savings in revenue generation. I wondered whether you could give us some flavour, either conceptually or hypothetically, or practically, as to what the link was between the modelling that you did and the results at the other end. So just what are the sorts of things, either hypothetically or practically, that managers would be doing differently based on applying a model such as this?
There was a couple of things that we did. If we look at some of the resource allocation questions, what we really were doing is something very simple to communicate to the organization. We had an estimate of the brand equity, let's say for the life category. We were then able to just say, if we were to annuitize that, what would that represent in terms of an annual benefit? And then say, we'll make up a number, $45 million is the annual, and we could quickly compare to what was the brand or ad tax that we were making as a transfer, cost to that organization, and we quickly showed that they were getting a great deal because they were far under the $45 million. And so it was a very simple conversation, and when we went to the financial actuaries, they quickly saw, yes, this looks like it is equitable. They went through the choice modeling. They thought that it was representative. So it was really the two stages, to present a dollar figure and then allow them to see how we arrived at that figure. So they also went in to look at the actual valuation issues on the valuation side of the model. But that was that example. If we look at how it was played in the communications, it really had a couple of angles that it took. One was, as we started looking at what were the drivers of the brand equity and what was the role, Venki mentioned, innovation was one of the strengths that GEICO had. We were looking and saying, where were we relative to them? If we were to move on that dimension, what would that imply? So we could help the marketing communications, our integrated marketing communications team, prioritize, what were the drivers that they were looking at. The other thing that we did was we triangulated these findings with some of the customer experience work, so we could show because there's a large customer experience team at Allstate, that the findings were actually in common, that the brand equity measures that we were measuring were also the equity measures that were part of the ad health component of the customer equity model. So we were combining them, and that allowed us to prioritize. And some of those things we quickly realized around some of the issues of price. While we were not perceived to be a very price competitive player, the model showed there wasn't as much leverage in us moving that relative to others. And so that was one of the areas that we triangulated on, that we saw in our ad health measures. We saw this model was also telling us the same thing. So those would be two examples where we were just moving forward on that. I think that the third area that the model helped us a great deal was what I mentioned at the beginning is we've historically had a conversation at Allstate. There were the actuaries and finance people on one end of the extreme, and then there were the sales organization and distribution on the other side. And how do we bring the two views together and reconcile why is it that one group talks just about the cost side of it and the price? We have 380 million price points. Why should we care about the brand? And we were able to show them why quantitatively. We were also allow the people on the sales side to have an understanding of what the things that they were doing, how they were valued, and why they mattered. And again, as we start going into the customer experience work, we had a link back to the brand to assist them in saying, yes, these are the things that we need to do.
Okay, one question I have is about basically dynamics. Customer-based brand equity is a very dynamic concept. It changes over time. The same thing with the financial implications and financial valuation. For example, even in your particular case, the relative brand importance and the offering value may interrelate, maybe structurally related to each other in the long run. So can you comment on the long-term implications and implementation of this approach beyond and above a snapshot measurement?
Well, we started this work in 2004, and since then we've been tracking this for the past 2 years and tracking the changes in relative brand importance and in the offering value and the brand equity metric across the category. So the intent was to have this as a long-term metric for long-term planning and long-term impact on shareholder value. It wasn't really intended as a one-stop. Well, we calculated brand equity and that was it. We went into this looking at it as a long-term proposition, built the infrastructure to support changes, as I mentioned a little bit earlier, that when our financial people restate some of the numbers, we had the infrastructure to rapidly recalculate brand equity based on those changes. And as you mentioned, changes in consumer perceptions over time, particularly how things change as a result of, say, those hurricanes that we had last year. Those changes, very important, but the model allows us to incorporate those on an ongoing basis.
It's probably worth also mentioning, when we look at the average tenure of an Allstate customer, 7 to 9 years. And so people aren't jumping in and out. So some of these numbers from a consumer perspective aren't moving dramatically. But there are a couple of things that are driving the category for us to be aware of. On the financial side, catastrophes. Katrina caused a lot of damage, fundamentally changes what the home market will look like in the southeast. And then on the brand front, we have people such as Geico, Progressive, who are direct businesses, and that's changing. So some of the dimensions in terms of brand equity, drivers of choice, those are changing, and so we do detect movement. And so the underlying model has, in the challenge we face is there are certain things from a financial perspective that are volatile because of catastrophes. And then on the consumer, we're detecting, that we aren't in a stationary environment because consumer preferences are evolving around a direct channel.
Okay, I think that's probably about all we've got time for, so I'd like to thank the Allstate team very much.